What if your pension could do this? Well, the thing people don't realize about pensions and investing is probabilities. If you'd like a free copy of this book, one of 18 that I've published from my time at the Financial Times as a columnist and Bloomberg TV, what they don't realize, and you can't quite see it, so let me explain, is take that 3-year mark and that 5-year mark. What you're trying to do, whatever you start off with, whether it's 1 million or 100,000 or even 10,000, what you're looking at is what's the probabilities, given the historic movements of the securities you've chosen to own, and let's assume they're relatively good quality companies, what is the historic probability and therefore future likely outcomes that you're going to get double your money in 5 years or even in 3 years? What are the probabilities? Now, history cannot guarantee the future. However, there is a small probability you'll get nothing. The world blows up, you get nothing. So that is allowed for. And what this kind of simulation does, it's called a Monte Carlo simulation, which in itself has drawbacks because the world is an uncertain place and maybe these probabilities we'll find are, in the light of things, all irrelevant because, like I said, the world blows up tomorrow. But what it at least does is give clients some degree of peace of mind. Peace of mind in the sense that they know a range of expectations and the probabilities assigned to them. It's a bit like if I said to you, if you toss a coin 100 times, what's most likely to happen? You'd say, well, 50 heads, 50 tails. What's guaranteed not to happen? Guaranteed what won't happen is 50 heads and 50 tails. If you don't believe me, do it. Try it. Okay, there'll be a range of probabilities. You might, if you toss the coin often enough, get 100 heads and 0 tails. People find it very difficult to understand probabilities. In fact, even maths professors find it difficult to understand probabilities. So when I do this for clients and we work out, well, what's the probability for the level of volatility that they want or risk they want to take, that they'll double their money, some of them voluntarily accept slightly lower returns for less volatility, even though they're not buying and selling. They're holding for a prolonged period of time because they just don't want a bumpy ride, even along the way. Okay. And by showing them likely probabilities, which again are not guaranteed into the future, but based on historic movements, just like the coin, based on what a coin can do, heads or tails, these are the likely outcomes and the most likely. And 100 tosses of the coin is a bit like holding a portfolio, let's say, for 5 years. They're statistically not identical, obviously. Now, the reason this is all important is not just because I can show off my maths prize at A level, which is probably all the statistics you need with all of this. It's so that people can have a degree of peace of mind. Not certainty about the future, but a degree of peace of mind. So they can look at it and they go, oh, China made a deal, or China didn't make a deal, or America didn't make a deal, but it's all fine because we still know we're on target. And as long as we're on target, we're happy. Save this video. It's going to be really important. Look at that every time you're not sure. If you'd like a free copy of my book, if you'd like a call with us, if you'd like to have a pension review, anything else, look, get in touch, okay? We think we're pretty good at what we do. I have a campaign for $1 million. Have a look at that website. It's to teach 1 million people how to add 1 million to their pensions across their lifetimes. Thank you.